What if I told you that while Bitcoin was designed to destroy the banking system, there's another cryptocurrency that was built to save it? What if the asset everyone calls a banker's coin, the one dismissed by crypto purists and ignored by retail traders, is actually positioned at the center of a multi-trillion-dollar transformation happening right now in global finance? What if XRP's price has nothing to do with its real purpose? Banks don't buy assets to watch number go up. They buy infrastructure that moves billions of dollars across borders in seconds instead of days. And right now, behind closed doors, the largest financial institutions in the world are testing something that most crypto investors have completely written off. This isn't about hype. This isn't about moon predictions. This is about understanding a system that operates on a completely different level than anything else in crypto. If you want to understand what's really happening with XRP, forget everything you think you know. Welcome to a different kind of analysis. Welcome to Thinkonomy. Hit subscribe, because today we're diving deep into the most misunderstood asset in cryptocurrency. Let's start with the uncomfortable truth that most people refuse to accept. XRP was never designed for you. It wasn't built for retail traders checking Coinbase every hour. It wasn't created for Reddit communities dreaming about Lamborghinis. It was engineered for a system that moves $150 trillion annually, the global cross-border payment system. And if you understand this single fact, everything else about XRP suddenly makes sense. Most people approach crypto with the same mindset. They look at charts obsessively. They chase price movements and momentum. They want fast gains, quick wins, emotional excitement, and constant validation from social media. When they look at XRP, they feel disappointed and confused. It doesn't move like Bitcoin, creating massive hype cycles and capturing mainstream attention. It doesn't explode like Solana or meme coins that 100x in weeks. It doesn't generate the constant dopamine hits that traders crave. So retail investors assume something must be fundamentally wrong with the project. But here's what they're missing. Institutions don't think this way. Institutions never have. They don't care about excitement or viral marketing campaigns. They don't care about narratives built specifically to attract retail traders. They don't care about Twitter sentiment or YouTube hype videos. They care about one thing: systems that actually work. Infrastructure that can handle billions in volume without breaking. Efficiency that saves millions in transaction costs, reliability that never fails during critical transfers, compliance that satisfies regulators in every jurisdiction. This is where XRP separates itself from everything else in crypto. To understand XRP properly, you have to completely forget how most cryptocurrencies are evaluated. You need to stop thinking like a day trader hoping for 10x returns. You need to start thinking like a system architect building global financial infrastructure. XRP was created to solve a problem that existed long before Bitcoin, before blockchain, before crypto was even a concept: the problem of moving money across borders efficiently. Right now, in 2026, international payments are still shockingly inefficient by design. The system relies on correspondent banking, a network built in the 1970s, using technology from that era. When you send money internationally today, here's what actually happens. Your bank doesn't directly send funds to the recipient's bank. Instead, the money moves through a chain of intermediary banks, each taking a fee and adding delay. Each bank in the chain must maintain pre-funded accounts in multiple currencies, locking up massive amounts of capital that could be used elsewhere. The process takes anywhere from 3 to 5 business days on average, sometimes longer. Fees stack up at every step, making small transfers economically unviable and costing businesses billions annually. And there's zero transparency. Once you initiate a transfer, you have no idea where your money is or when it will arrive. Banks have accepted this broken system for decades because they never had a viable alternative. The infrastructure was too complex, too entrenched, too political to change. Every attempt at modernization required coordination between thousands of institutions across hundreds of countries with different regulations, different technologies, and competing interests. It was considered essentially impossible to fix. Then Ripple proposed something radical that changed the entire equation. Instead of trying to move money through the existing banking system, move pure value as data. Instead of relying on chains of correspondent banks, use a neutral bridge asset that any institution can access. Instead of waiting days for settlement, complete transactions in 3 to 5 seconds. And instead of locking up billions in pre-funded accounts, provide liquidity on demand exactly when needed. XRP was designed specifically for this purpose, and this purpose alone. It is not trying to replace fiat currencies or become a new form of money. It is not designed to be a speculative investment vehicle for retail traders. It is engineered to act as a bridge for liquidity between any two currencies in the world. This fundamental difference is why comparing XRP to Bitcoin completely misses the point. Let's be very clear about something that confuses most people. Bitcoin was created as a reaction against the traditional financial system. It was designed to exist completely outside of banks, governments, and centralized control. The entire philosophy of Bitcoin is adversarial to institutions. XRP was designed to work within the existing system, not to replace it or fight it. That philosophical difference changes absolutely everything about how these assets function and who uses them. For years, XRP's price behavior utterly confused the retail market. While Bitcoin went through dramatic cycles from $20,000 to $3,000 and back to $69,000, XRP remained relatively flat and boring. While DeFi tokens exploded 50x in months during the 2020 summer, XRP barely moved. While meme coins like Dogecoin captured mainstream attention with Elon Musk tweets, XRP generated no excitement. Retail investors looked at this price action and reached an obvious conclusion. XRP must be dead. Development must have stopped, institutions must have lost interest, and the project must be failing. But none of that was actually true. The real reason XRP stagnated had nothing to do with technology or adoption. It was regulatory uncertainty. The SEC lawsuit against Ripple, filed in December 2020, froze progress in the most damaging possible way. Not through an outright ban that would have forced a clear outcome, not through a rejection that would have allowed Ripple to pivot, but through years of legal uncertainty that paralyzed institutional adoption. Here's why uncertainty is worse than a ban. Banks absolutely cannot gamble with regulatory compliance. They operate under strict oversight, and one violation can result in massive fines or loss of banking licenses. Investment funds cannot take regulatory risks with assets that might be deemed securities. Their fiduciary duty legally prevents it. Exchanges cannot list assets that could bring legal consequences from regulators. The liability is too great, so everything stopped. Not because the technology failed, but because institutions require regulatory clarity before deploying billions of dollars. During this painful period, retail investors watched price stagnate and walked away disappointed. But Ripple didn't stop building for a single day. While the lawsuit dragged on and retail attention disappeared, Ripple continued expanding aggressively. They built out payment corridors across Asia, Latin America, the Middle East, and Africa, regions where cross-border payments are most expensive and inefficient. They refined on-demand liquidity solutions, their flagship product that uses XRP to settle payments in seconds. They partnered with over 300 financial institutions globally, including major banks in Japan, Thailand, Brazil, and the UAE. They processed hundreds of millions of dollars in transaction volume through RippleNet, proving the technology works at scale. This is exactly how real financial infrastructure develops in the traditional world, slowly, methodically, without public spectacle or marketing hype. Institutions don't announce what they're testing because competitive advantage matters. They don't broadcast pilot programs because regulatory scrutiny increases. They wait until systems are completely proven, legally cleared, and operationally stable before going public. This is why XRP often feels completely invisible to the crypto public that obsesses over daily price action and social media trends. But invisibility absolutely does not mean irrelevance. In fact, the most important infrastructure is usually the least visible to end users. You don't see the SWIFT network, but it moves trillions daily. You don't see Visa's back-end systems, but they process thousands of transactions per second. You don't see internet backbone infrastructure, but it powers the entire digital world. XRP is being built as that kind of invisible infrastructure. Then in July 2023, something massive happened that changed everything. A federal judge ruled that XRP itself is not a security when sold on public exchanges. This wasn't a complete victory because institutional sales still faced restrictions, but it provided the regulatory clarity that institutions had been desperately waiting for. The market reacted immediately. XRP's price jumped over 70% in days. Exchange listings that were frozen for years suddenly resumed. Institutional interest that was dormant exploded back to life. But more importantly, it removed the legal uncertainty that was the primary barrier to adoption. Now we arrive at the question that creates the most heated debates and strongest reactions. Why do serious financial analysts, not YouTubers chasing views, believe XRP could become extremely valuable in the future? The answer has nothing to do with hopium, speculation, or wishful thinking. It comes down to pure liquidity dynamics and mathematical necessity at institutional scale. When you're trading small amounts, price feels somewhat abstract and arbitrary. A few dollars up or down doesn't fundamentally change anything. But when institutions move billions of dollars across borders daily, price becomes absolutely critical to operational efficiency. Here's why. If XRP is genuinely adopted as a bridge currency for settling large volumes of global transactions, the price per token directly affects how efficiently the system works. A higher price means the same dollar value can be moved with fewer tokens changing hands. This reduces slippage, the price impact when large orders execute. It reduces the risk of liquidity shortages during high-volume periods. It increases overall system efficiency and reliability. This isn't speculation or hopium. This is basic financial mechanics and mathematical reality. To move $1 billion in value, you need different amounts of XRP depending on its price. At $1 per XRP, you need 1 billion tokens. At $10 per XRP, you need 100 million tokens. At $100 per XRP, you need only 10 million tokens. The higher the price, the less liquidity required to move massive amounts of value, which makes the entire system more efficient and scalable. Now, does this mean XRP is guaranteed to reach extreme valuations like some communities predict? Absolutely not. Nothing in markets is guaranteed. Does it mean current valuation is arbitrary or based purely on speculation? No. Valuation at institutional scale is driven by utility, volume, and efficiency requirements. This is the fundamental difference in how retail traders versus institutions think about assets. Retail traders think in terms of profit percentages, chart patterns, and getting rich quickly. Institutions think in terms of flow efficiency, cost reduction, and system optimization over decades. This massive difference in mindset and time horizon is exactly why XRP creates such polarized, emotional opinions in the crypto space. Let's address the elephant in the room: centralization and legitimate concerns. XRP critics correctly point out that Ripple, the company, holds a significant portion of total XRP supply. The XRP ledger, while technically decentralized with independent validators, has closer ties to a private company than Bitcoin or Ethereum. There are valid questions about whether a private company should control infrastructure for global finance. These concerns are not baseless FUD. They are legitimate considerations. But context matters tremendously. Every major financial system is centralized. SWIFT is controlled by a consortium of banks. Visa and MasterCard are private corporations. Central banks are government entities. The correspondent banking system is entirely controlled by major international banks. The question is not whether XRP is perfectly decentralized by crypto purist standards. The question is whether it's more efficient, transparent, and accessible than the existing alternatives it's trying to replace. By that measure, XRP represents a significant improvement. The XRP ledger is more transparent than SWIFT. Transactions settle in seconds versus days. Fees are fractions of pennies versus percentages. Anyone can validate the network or build on the protocol. Is it perfect? No. Is it better than the current system? For many use cases, yes. Regulatory risk remains real even after the partial court victory. The SEC could appeal, new regulations could be introduced, different countries could take hostile stances, and the legal landscape continues evolving. Competition is also intensifying rapidly. Central bank digital currencies, or CBDCs, are being developed by dozens of countries. If governments create their own digital currencies with instant settlement, private bridge assets like XRP could become less necessary. Other cryptocurrencies like Stellar, which was created by a Ripple co-founder, offer similar functionality. Blockchain technology from traditional finance companies could provide alternatives. Nothing about XRP's future is guaranteed or certain, but the same is true for every cryptocurrency, every technology investment, and every emerging system. So what does all of this actually mean for someone trying to understand XRP rationally? First, XRP operates on a completely different timeline than most crypto assets. While meme coins pump and dump in weeks, infrastructure adoption takes years or even decades. The institutions Ripple is targeting move slowly, test extensively, and deploy cautiously. Patience isn't just recommended, it's required. Second, price action will not correlate with progress the way retail traders expect. Major partnerships might not move the price immediately. Successful pilots might generate zero hype. Then suddenly, regulatory clarity or a major bank announcement creates explosive moves. This is the nature of institutional adoption. Third, XRP is an asymmetric bet on financial system modernization. If global payments infrastructure truly modernizes and XRP becomes a standard bridge asset, the upside is enormous. If CBDCs dominate or existing systems adapt without needing XRP, the downside is significant. Fourth, understanding XRP requires separating emotion from analysis completely. The tribalism in crypto creates extreme camps. XRP maximalists who tolerate zero criticism and believe $500 per token is inevitable, and XRP haters who dismiss everything as a scam without examining the technology. Both extremes miss the nuanced reality. Fifth, XRP is not for everyone. If you want excitement, constant price action, and community-driven hype, XRP will disappoint you. If you want to understand a long-term institutional play on financial infrastructure, XRP deserves serious analysis. The real fundamental question is not whether XRP will reach a specific price target. The real question is whether the global financial system is genuinely ready to modernize its payment infrastructure. Because in markets throughout history, the most misunderstood and boring assets often play the biggest roles in system-level transformations. The internet was dismissed as a toy. Amazon was called an overvalued bookstore. Bitcoin was laughed at for years. Sometimes the things that feel boring, that lack excitement, that institutions adopt quietly, are the ones that reshape entire systems. So where does this leave us? XRP represents something genuinely unusual in cryptocurrency, too institutional for crypto purists who want decentralization above all else, too boring for retail traders who want daily price excitement, too slow for people expecting immediate results, but potentially positioned at the center of a multi-trillion-dollar transformation in how money moves globally. Understanding XRP requires intellectual honesty. It requires acknowledging both the genuine utility and the real risks. It requires patience in a market that rewards impatience. It requires thinking in years and decades, not days and weeks. XRP might succeed spectacularly if financial modernization accelerates and regulatory clarity expands. XRP might fail if CBDCs dominate or institutions choose different solutions. Both outcomes remain possible. What's clear is that XRP is not what most people think it is. It's not a get-rich-quick scheme. It's not dead or abandoned. It's not a simple scam or banker conspiracy. It's a long-term institutional bet on whether blockchain technology can genuinely improve the efficiency of global finance. And that's a far more interesting question than most price predictions. If you're here for analysis instead of hype, for understanding instead of speculation, for nuance instead of tribalism, then you're exactly where you need to be. This is Thinkonomy, where we analyze what actually matters. Hit subscribe if you want more deep dives that go beyond surface-level crypto content. Drop a comment with your honest thoughts on XRP, whether bullish or bearish. Let's build a community that values intelligence over emotion. Thanks for watching, and I'll see you in the next deep dive.